Welcome, everyone. I'm Mike Brashazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journeys, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome back to another exciting episode of the What Matters podcast, where we dive deep into conversations that truly matter. I'm your host, Mike Brashazadeh.
And I'm Ashley Ward.
And today we're thrilled to have Steve Tuttle, partner and chief investment strategist and CCO of Signet Financial Management, joining us. Signet is a national wealth management firm with approximately $1 billion plus in assets under management. Steve brings over 25 years of experience in the investment industry, offering clients a deep understanding of equity and fixed income investments, option strategies, portfolio management, and financial planning.
Steve's extensive experience and dedication to helping clients achieve their financial goals are evident in his work. We're excited to have him share his insights with us today. Welcome to the show, Steve.
Thank you very much. I am excited to be here. Thank you.
Well, let's get started and dive right in. So let's start by exploring your journey, Steve. Could you tell us a little bit about your background and how your career has evolved from your early days at JP Morgan and Waterhouse Securities now to your current role at Signet Financial Management?
Sure. So I, in the 80s, I was in college and watched the movie Wall Street and didn't really have a career path, but I figured, hey, that seems like something to do. I grew up in New Jersey. So coming out of college, I got a job on Wall Street and bounced around a few different places. Quickly found out that the Wall Street dream was largely about selling, and that wasn't for me. I transitioned to a small, fast-growing firm, Waterhouse Securities, which essentially was a smaller version of Charles Schwab, discount broker, very service-oriented. And I was able to embrace that. Providing a lot of client service, getting involved in a lot of trading. That's where I found my love of options. And it was a good journey. It was a fast moving firm. So I also evolved into various management roles, learned a lot about the industry, and met a lot of good people. Somewhere along the line, I participated in the dot-com bubble. So it seemed fairly easy to make money, but yet I saw many retail investors losing money, even though it was a good bull market. And I started developing my interest in providing financial advice and portfolio management. So I went back to school at night, kept working, graduated from Fordham with an MBA in finance. And at that point, I did transition to JP Morgan and got much more ingrained in providing financial advice, portfolio management in a much more sophisticated way. And I loved it. Soon after, I started having kids and settled down, and I came across an opportunity to move outside New York City, move my family to the suburbs, and I made the switch to the independent side. And I was immediately attracted to the independence, acting as a fiduciary with no conflicts of interest to be able to provide pure advice for what's best for our clients. And it was a tiny firm. I was number 3 in that RIA, working at Mendham, New Jersey. And so I embraced the whole process, got very, very involved. Eventually, I became a partner. Eventually, we merged with another firm and kept evolving with the industry. And now I'm one of 4 partners. I'm based in New Jersey. We are, I think, very successful. We have a nice group of clients that we understand and they understand us. And I think the key story for us is being that fiduciary, providing what's best for them, focusing on their outcomes, not necessarily product. And that whole journey is what I'm looking for, for the rest of my career.
So let me ask you a couple questions there. So when you said that you went back to school there, right? Did you feel that taking a step up within your education helped you in your career, or was it just was that needed to get the position that you were looking to get?
I think it was needed, and it definitely did help me in my career. where I was, again, it was service, it was trading. I was doing well. My background, my education prior to that was economics, so I really didn't get the in-depth financial analysis. But I really enjoyed the first 5 or 6 years figuring out exactly what I wanted to do. And I think that helped me define, hey, you know what? I want to be more than just someone providing service and doing trading. I want to add more value. And the MBA was a way of doing that. And the other side of it is, without that, it would have been harder to get into a more established firm like JP Morgan, I believe.
So going back to school, and you went to JP Morgan afterwards, correct? It was
Yes,
Waterhouse, then JP Morgan, if I'm not mistaken.
right.
Then you said, okay, you know what? Yeah, I want to go. I want to go do something smaller, be more recognized. Um, how did that transition go from you going from those larger wirehouses to Signet?
It was a risk going from a big established firm uh, and the safety that provides, going to a two-person shop and essentially starting over. Uh, that was a risk, but it was a risk that I embraced. It was also opportunity to do more, to have more impact on our clients directly than I would have at a much bigger firm. And thankfully, the risk paid off. And it hasn't always been smooth, obviously. As an independent advisor, not working for a big firm, our success or failure is linked to the market, no matter what we do. We are on the asset under management model. And if the market sells off, goes through a horrible 2008 period of time, our revenue goes down. Um, Same thing, I guess, could be said for bigger firms, but in bigger firms are probably better positioned to weather that. Although in 2008, you could argue that that wasn't. I have some friends who were working at Lehman Brothers at the time, so maybe the independent side was a brilliant move, and I just didn't know it.
So tell me about when going to Signet at that time. Uh, how many people were at Signet when you joined, and what year was that?
So that was 2001. So it was at the end of the internet bubble. It was the start of the lost decade in stocks. At the time, it was Krasny Financial. It was a one-person RIA. John Krasny was the founding partner. He was a bond guy. He was a bond salesman. He needed someone to introduce and manage equities, asset allocation, and that was my role. And so again, great experience to get in there and add value to an existing client base. I wasn't selling, but I was providing services to them. But that's inherently scary. It's one person, an assistant, and me, and we were working out of an office, a garage office off the back of his house. So very different than walking into a premier JP Morgan building or down on Wall Street where I was with Waterhouse Securities. Very different environment, but I was ready for that change.
Wow.
And so in going to that, we'll call it a three-man shop there, right? Did you come on as an owner of the company, or did you come on
Not
as?
initially. Not initially. I was just a supporting employee who I came across. Not I came across through an online ad, and nothing nothing extraordinary about it, other than it was an opportunity, and I took it. I took a chance, and it worked out great. So it wasn't until years later that when John was starting to make noise of retiring, succession planning, that I was the natural successor there, and that's where I became a partner. And then later we merged with another firm, brought on two more partners, and away we went. And that was when we merged with the other firm, and I became a partner. That was when we transitioned to Signet as the title of the firm. We
God,
wanted to de-emphasize the sole proprietor, the single owner, John Krasny. And he stayed around for a few more years, but gently rode off into the sunset.
what year was that you guys merged?
That's a tough question for me to remember. I would say that was 7 or 8 years ago. That was 7 or 8 years ago.
Oh, so fairly recently.
Yeah, not. I was with Krasny for a long time.
Wow. And obviously, you guys didn't stay a three-man shop. How big did Krasny's shop get to? Um,
So we got up to around 15 employees, not all in Parsippany, but about 15 employees. Some in Florida, some in Virginia.
and how many total teammates do you guys have now?
Around 20. Some are independent advisors who aren't technically employees, but they use our services and they're deeply ingrained in our process. But and we do have an investment team. Some of them are all they do is research for us, and so their role is a little smaller.
And so how many total would you say advisors do you guys have, and then support staff underneath that?
So we have 6 advisors, 4 partners, and four main client service reps. And then we do have a few traders in Virginia that do a lot of the portfolio management, entering the orders, things like that. So we're decent size.
So let me ask you this: when you guys had merged with Signet, and correct me if I'm wrong, because we get public information, so it's not always accurate. It shows you guys had crossed $1 billion in your AUM there.
Yeah.
Was when you had merged, with Signet? What was the size of the AUM at that point?
Krasny was around 200. So the Signet was the established firm that merged with us. We took on their name. And so that's
Okay.
why if you're looking at documents, you'll see Signet existed prior to when I'm saying we merged, because Krasny was independent. Krasny was around 200, Signet was around 150. So 350 to $1 billion is
Wow,
what we've taken place in less than 10 years.
wow. In that type of growth, has it been all organic, word of mouth, or have you guys done inorganic acquisitions? How's that growth came about there?
So it's been primarily organic, although I will say early on, much of the growth, at least on Krasny, came from the Advisor Direct program at TD Ameritrade. TD Ameritrade was actually Waterhouse Securities where I started. So when I moved over to the independent side, I knew many people that were at TD Ameritrade that I worked at beforehand. And John Krasny and I were part of their referral program. We were primarily fixed income managers at the time, so we were the only fixed income manager on that platform. Income was good, safety was good, so we were able to grow by partnering with TD Ameritrade. Later on, when we merged with Signet, we continued that relationship, although it didn't. TD Ameritrade started taking that program grew and grew. More and more advisors, more competitive to get leads in there. We did have a relationship with Scottrade as well. We had organic growth through referrals through Scottrade as well. Of course, Scottrade merged with TD now with Schwab.
Wow.
We're now not part of any referral programs. We're now growing primarily by referrals, increasing wallet share. We have started to explore inorganic growth with some small successes. But that program's in its infancy, and I would say that space also is very competitive. There's some very big players out there right now that have more capital to compete in that space. Where we compete on is relationships. Someone who wants to help grow with us and is a good fit with our culture. That's what we're looking for. But that's a slow process. That's not a transactional process. That's a matter of meeting someone, having a good relationship with someone, seeing the fit, and then making it work. And as I said, we've done that with just 2 small advisors right now.
Good for you guys. Yeah.
Thank you.
and,
Thank you.
and I know that to find a team that's going to be culturally aligned with you guys, you never want to have a bad apple come in and spoil the bunch and take advisors and and leave. And I get where you're coming from there. So
Well, that's the challenge. I mean, we're at $1 billion, and I've read it many places, but I feel it. That's the level where you need to start institutionalizing the business more. You need to invest in the business more. You need to bring on more people more. I can't do it all any longer, and that's That's hard because what has made us successful to this point to get us to $2 billion, $3 billion takes more resources, which means more investment and also more risk. And I think the biggest risk is that cultural fit. Part of our success has been that we work together, we're aligned with our clients, and they like us, we like them, and they know us. When you start introducing more and more people, there's potential for that to get sidetracked. And so that's where we are right now. We do still want to keep growing, but not at the expense of our core business, which is got us to this point.
Good for you guys.
Thank you.
So, Steve, along the way through your 25 years of experience, any advice for those aspiring wealth managers, someone entering the field, maybe someone who's thinking about going independent? What advice would you have throughout your experience in your career?
Great question. First of all, it's 25 years in the independent space. It was about 10 years on Wall Street. So about 35, pushing 35 years so far. I will say, although I like the independent space and although I do think it's a great path, I do think the training that I received as a young newbie out of college on Wall Street was fantastic. So working for a TD Ameritrade, a Schwab, a Fidelity, I do think that's not a bad path for anyone because you can get a lot of good training and resources to hone your skills and then to take that wherever you want, whether it's the independent space or a bigger firm. So I benefited from that. And I would encourage anyone, don't be discouraged that you didn't get your first job at Goldman Sachs or JP Morgan. There's plenty of other good firms out there. And really what's most important is the training you're going to receive, the mentors you're going to work with, and the opportunity to prove yourself. And in my experience, my opportunity to prove myself really was at Waterhouse Securities. And I'm still benefiting from some of the key lessons that I learned back then.
Really cool.
And so building a successful firm requires more than just experience. Can you tell us how you and your team at Signet differentiate yourself in such a competitive market that we live in today? Any strategies that have been crucial for your firm's success?
That's the trick, isn't it? If you look at all the marketing brochures from all my competitors, many of them are very similar. So how do you differentiate yourselves? And there was a time earlier on in my career when I was gung ho on what I had learned at business school and my own personal education, where I thought the difference was investing. It was alpha, and you still can make a difference there. But what I've learned is that it's the relationship, it's the soft skills that differentiate. There's lots of good investment strategies out there. There's no one strategy that's appropriate for everybody. I think the difference has been that we can build trust and we can provide great service and deliver it, yes, with sophisticated investment products and financial planning and experts. But what differentiates us ultimately, and it's not something you can just write down and say, this is what differentiates us, but our clients feel it. It's the trust that they have with us and the fact that we're not Merrill Lynch. We're not JP Morgan. We don't want to be that big. We want to have that personal relationship with our clients. And that's what keeps us growing. That's what keeps our clients comfortable to refer their neighbor or their mother-in-law or their son-in-law to our firm. And ultimately, that's been the key to our success. Great investing. I believe in what we do on the investment side. Financial planning, I think, is fantastic. But ultimately, it's the service that we deliver to our clients that keeps them here. And we try to communicate that message across all of our employees. They are the key to the success. They are the key to us implementing our investment strategies and helping clients stay on course.
And speaking of which, it looks like you guys have done a great job because over the last 7-8 years, you've 3x the size of your RIA there. Had you guys, you said you've gotten a couple advisors that you recruited a couple advisors. Was the bulk of your advisors that are at your firm, were they homegrown, or did you recruit a lot of them out of other firms?
Um, None came right out of school where we trained them. We're just starting that process right now. We have a few people. One of them, who happens to be my son, is right out of school, where we're able to teach them exactly how we want them to coexist. But one of our other partners, I mentioned my background in Waterhouse Securities. One of my other partners, Sean Hirsch, he made his first stop at Fidelity. And so I think he would express that same thing, of the training that you receive at a firm like that is good. Um, the other advisors have been in the industry, and it was a good fit with us. I mean, one of the advisors, who happened to be a personal friend of mine, so the culture fit was good. He came out of the Wall Street environment, and he was very successful selling in the old days of phone sales. But he transitioned over to our side, and he's happy he did so. And the others also came from the brokerage side, and then eventually went the independent route with us.
So out of curiosity, there, I have to ask this question. My father owned gas stations, right? So I had no desire to be in that business. Had my father been in this industry, I would have dove right into it. And I got to ask, how has it been so far working with your son?
It's been working great. Father son, or any inter-family relationship, can be tricky. So I was a coach. I coached him a lot, so I learned how to have a pretty good relationship with him. But I also learned that dad is not the right person always to lead
Mhm.
in a workspace. So while he's in the same office with me, he reports to another person. Most of his day to day is with another person, and I think that works. He knows I'm here. He knows he can ask me any question, but he's learning a lot. He's getting exposure to a lot, and he's proving himself with other people, not with me necessarily. So I think that's a good formula for success so far.
And what do you see in the next, call it 3-5 years out, for the growth of Signet? Where do you guys see yourself in the upcoming years?
Yeah, I think I do think we're at a stage right now where organic growth, we're going to probably continue at the 10 to 15% route. Hopefully, we get a few more percentage points each year in the market, although I have my doubts about that. And I think that part of it is we can do a very good job of. We've proven ourselves there. I think we can scale that well, and I think we're at a size right now where we don't have to. It's equally important that the new clients that we bring on are a good fit with us, as it is to when we were younger, where it was any new assets were good assets. We don't feel pressed to do that. The inorganic side is an area where I think there's potential. We are looking at it closer. There's more uncertainty to that. That could take off, or not. And I'm not. I have less certainty of that. I think it's something that's worth doing. I mean, you read about and you see all the numbers about the number of retiring advisors in the next decade, and how the average age of the typical advisor is pushing 60 years old. There is an opportunity to um, to service clients of advisors that are retiring, and so we're gonna look at that. But like I said, that's a newer, like I mentioned earlier about taking risks. That's a risk. I think that's a risk, but I think it's a risk worth taking, because there is an opportunity there.
Yeah, yeah.
And Steve, what do you envision for the future of wealth management, the future of the industry? Any trends, technology, strategies that you think are really going to shape the industry in the coming years?
Yeah, there's a lot going on. I mean, AI is top of mind, but before that, it was the internet. The industry is always going to evolve. and we are excited about the efficiencies, the productivity that AI can bring. I'll admit we're at our infancy and starting to use some of those tools. But the other side of that is I don't expect human nature to change. Uh, we humans are not wired very well for investing. Fear and greed get in the way. Emotions get in the way. And
Right.
so going way back to when there was no internet and I was picking up the phone, and if you wanted to know what your portfolio was, you'd had to ask me. And if you wanted to place a trade, you had to talk to me on the phone. Now everything's on your phone 24 by 7. Access to information is fantastic. Have anyone have client returns, have retail investors returns gotten any better because there's more information? I'd say no. Um, so the need for advice, the need for trusted guidance is not going away. And so that's where we're laser focused on. And the new evolution of the industry, the I think that should help us reach a broader audience of clients and do it in an efficient way. I think a big trend is personalization, the ability to customize portfolios. We don't need to have one or two or three model portfolios for every client. We can customize for everyone. Tools have gotten us to a certain point. We do have a lot of great rebalancing tools and models and ways of customizing portfolios. But I think AI is really going to take that to the next level. Not only with personalizing portfolios, but providing information when clients want it, how they want it, all that sort of stuff, which is difficult for 100% human interaction. So the tricky point is, how do you balance that digital delivery versus the human delivery? I think the human delivery is crucial. I'm not convinced AI is going to be able to replace that.
Mhm.
But I also think it's going to be a very important part of the industry.
I completely
Yeah.
agree with that. I think that AI will make everyone's job a bit easier, but replacing humans, I can't see a human making a financial obligation, or committing to their money with something that's robotic, right? I just can't see it happening. They've tried it out in so many other industries, and people always want to talk to a person. So
That's my experience,
yeah.
and I just don't see that changing in our humans. There will be some do-it-yourselfers who are comfortable with that, who want to do that, but I think there'll be a much bigger audience that will continue, of people that need to see a voice, to hear a voice, to feel empathy, to ask questions, and to build that trust. It's hard to build trust with a machine.
Absolutely. And shifting to the topic of investments, Steve, what sectors or types of investments are you most excited about right now? And any that you believe will drive the next wave of wealth creation?
So right now, I'm excited. I'm excited about the laggards to some extent. So by that I mean the last decade plus, 20 years plus, it's really been a large cap beta market. Market cap weighted indexes did fine, and investors did fine, just buying and holding. Um, I think the next 10 years might be a bigger challenge, particularly for market cap weighted indexes. Some of that, I think, stems from inflation probably being higher for longer. I do believe that. Are we going to be at 9%? No, I don't think so. Are we going sub 2? I also don't think we're gonna stick there. I think there's enough challenges on the debt front, on reshoring back to the U.S. These are inflationary trends that aren't going to go away. So we may be in a regime that's 3 to 5% inflation, and in that environment, I think being more selective, being more flexible, is going to be the most effective way to ground out alpha for portfolios. And so that being said, we do have as a firm, Signet, we do believe in multi-factor investing. So essentially, we do run some strategies that take an index as a starting point, weed out what we believe are bad stocks, and then focus on stocks that we believe have attractive characteristics across value, profitability, growth, momentum, and that strategy has held its own. Although it's been tough to beat the S&P 500. But I think the next 10 years you should see benefits to that type of strategy of being more selective. I also think risk management is going to play a bigger role. And many of our clients, I mentioned when I started with Krasny, we were essentially a fixed income shop. We still have a lot of clients where they're older, they've built their wealth, they just want to keep it. And they don't need to beat the market. They need 4, 5, 6% returns with as lowest risk as possible. The environment for that right now, I believe, is attractive. Interest rates are back in a more normal range. There's some very interesting access to private markets, private credit, structured notes. We do a lot of options overlays. These are all, we approach all of that as a way to diversify, as a way to help manage the risk of stocks. It's well documented that stocks are going to be your best investment over the long period of time, but it's also well documented that they will go through periods of 30, 40, 50% drops once or twice every decade. The average investor can't take that, particularly an investor who is retired and doesn't have new income coming in. So I think the opportunity to differentiate from the broad markets is important. I also think the ability to use risk managed products and strategies to help clients stay invested, those are the opportunities that are going to drive the investment world the next decade, I believe.
And shifting gears outside of equities and fixed income, what do you feel about the real estate market? Commercial real estate has, I would say gotten kicked to the curb a bit over the last few years. Do you think it's a good time to buy commercial real estate? What's your feeling about residential and commercial at the current moment?
So it may be early on commercial real estate, but I have a high conviction level that there's opportunity there for smart managers. I do know some prominent managers, including Blackstone, are putting together funds specifically to put to work buying commercial real estate and debt at very distressed levels. And when it comes to that, yeah, there's risk. There's a lot of risk, but it all comes down to the price you can get in on. And while we do a lot on our own, there's some area. I mean, part of our value is know what you're good at and know where your strengths are. If we were to invest in like private real estate, it would be through a fund manager. And so I do think there's opportunity there. I think it's a little early. I think residential also has a lot of potential that hasn't been under as much stress as the commercial side. But I think if you see there's been too much under investment in real estate, in housing. And I see it in this whole generation. I have a 26-year-old son and a 24-year-old son. It's hard to find a place to live that's affordable. And I see that all over the place. So I do think residential is going to continue to be a good place to invest.
Thank you. And the final question I have for you, and we touched on this a little bit a couple questions ago, but I wanted to continue hearing your thoughts on this. What do you feel about where the overall economy's at right now? I mean, we've had with COVID happening and the 10-year treasury going from 0.7 all the way up to 5 at one point, now hanging down there at around 4. So many things have taken place over the last few years. Where do you feel that the next 5-10 years out is going to look like for the markets?
Yeah, I mentioned it earlier. I do think we have to dial down our return expectations just a little bit. I mean, the last 10 years, we were at double digits for just buying and holding stocks. I don't see that. I think that from a valuation starting point, we're much higher. There's much more concentration in the market in some names, although they're great names. Uh, I'm worried that they're going to become the next Cisco, great company that loses value and never sees its highs for 20 years.
Right.
Um, so I am. We are a little cautious with that. Do still think stocks are the best place to invest for a lot of reasons, but being more selective, focusing on quality companies, focusing on companies that have the ability to increase prices because we do believe inflation is going to continue to be a problem. Companies that can deliver a competitive edge. Um, and I also think some of the undervalued or laggard areas of the market, smaller caps, mid caps, even some foreign companies, even though their fundamentals don't look as great, the prices are attractive. So to us, it's more diversification. It's adding alternatives into that mix, and it's managing the volatility so that when the sell-off happens, there's an opportunity to redeploy cash, take some profits out of some safer investments, put them in other good investments at lower prices. And I think you're going to see a much more tactical environment over the next 5-10 years. You're going to need to.
Are you saying with value stocks with so I'll give you an example. There's been companies like Nvidia that has just keeps it just keeps going up. I mean, it's gone down a bit, right? But you see companies like Nvidia, but then you see other companies out there like for example Snapchat and Lyft and companies that haven't regained their pre-COVID values again. Do you think that there's opportunities in some of those companies that haven't rebounded, or do you think that they might be the next Cisco and not see their price for the next 10 to 20 years?
I do think you have to look at valuation as it doesn't mean you have to buy only the cheapest out there, but and that's part of how we approach it. We look at valuations a lot, but we also look at momentum and profitability. So you want that nice blend of combination. And often, like Nvidia, we haven't owned to this point, but I do know after the recent pullback, it's come down just enough, and its profitability has increased just enough that it's something that we're seriously looking at. Some of the other names, while they might have the revenue growth, they don't have the profitability, and their momentum just broke down. So I'd be a little apprehensive about getting into those names. But you mentioned value. Like I do think like something as simple as energy's not going away. They're boring companies, but they generate a lot of free cash flow. They the demand for energy is not decreasing, although we are as a global community, we're trying to become more efficient. I just don't see that happening for the next decade plus. So energy to us, even though it's a small part of our allocations, I think that could be an increasingly important part of the portfolio. Same thing with materials. Same things with other areas that haven't done as well in the recent past. But now there's going to be a broadening out of returns. There needs to be a broadening out of returns for the market to continue higher. You can't just have 7 names continue to go up 50% a year. It doesn't work. I've seen it too many times.
Right. Right. Does it kind of does time frame that we're in right now kind of give you flashbacks of that 2001 time frame? Or it,
It does. It
yeah,
absolutely does. I mean, there's different. I mean, I lived it. I lived the '90s and I lived the 2000s. And in the 2000s, as when I moved over to the RA space, we we added a lot of value for our clients by broadening out, by selling down the internet darlings and adding small cap, adding value, adding high yield bonds, adding REITs. And I could very easily see that happening over the next 10 years. I think fundamental research and good advice and being selective is going to have an increasingly important role. because it's just going to be too hard, I believe, for the NASDAQ and the S&P 500 to continue driving returns when the concentration is so focused on just a few names. Great names, great companies, but as we know, great companies don't always equate to great investments in the short term.
Right.
We own and we like a lot of these companies. It's just we do it in a measured way.
Yeah.
Yeah.
Interesting times ahead for sure. Well, Steve, thank you so much for joining us on the show today, sharing your wealth of knowledge and your insights, not only with us, but with our audience. We really appreciate your time with us today.
Thank you very much. I enjoyed it.
And to our listeners, thanks for tuning in to another episode of the What Matters podcast. Be sure to join us next time as we continue to explore topics that truly matter. Until then, take care and stay curious. Thanks, everyone.